taxman is smiling, the finance minister is smiling. Should we be smiling?
Well, we should be smiling in the sense that, you know, the state has given us an opportunity as a private sector to get space and do invest, because the state is not living beyond its means. Yeah. So having a 5% deficit is not as bad compared to our trading partners, particularly European countries, which are running deficits far above 10%. So in that respect, it gives us that opportunity. However, we know that as the state is living within its means, a lot of certain households live far beyond their means. Despite the low interest rate environment, we still have got long ways to go to reduce our debt to disposable income, which is running above 70% at the moment.
What's improved in South Africa if the tax revenues are looking better? More South Africans paying tax?
Well, what has happened is that with the tax, with the interest rate cuts, we've seen a lot of consumers being able to service their debt and have some disposable income left, which they've gone back to the market to use it across various goods and services. And therefore, one of the areas where we've seen significant gains is in the motor industry, where, as we'd seen earlier in the inset, that South Africans are buying more cars. So therefore, going forward, when interest rate cycle turns, it's raising issues for us around the sustainability of this growth, because if the interest rate turn in the last quarter of this year, we may see the economy again reversing. So we're much more dependent on how the interest rate environment happens, and more importantly, whether food prices are going to go up, and what happens to our currency, which you know has strengthened quite tremendously and shielded us against the high price of energy. If it had to give up a bit, we may find ourselves that our growth gets throttled and go back to 2% again.
Okay, you say that 5% GDP as a deficit is a manageable figure, but for a country that needs to grow above 7%, is it really?
Well, this country can even go to about 10% deficit. The challenge in South Africa is how that deficit money is going into. If it's going to consumption, it's very, very bad. However, if the state uses that money into investment infrastructure, including education, then it's good investment, because human capital, if it's in education, will hopefully bring a return in terms of the resources that South Africa needs to develop its technological capability. But secondly, also in terms of infrastructure, we'll be lowering cost of doing business in our country, making sure that entrepreneurs do compete on the same level with our trading partners.
This idea that South Africa is not living beyond our means, is that really true? I mean, we had the budget just a few weeks ago, and we know that comparatively speaking, between 2008 and 2014, South Africa's debt has doubled and set to grow.
Well, it has doubled in the sense that government is saying, here's a window. Given that everyone is living beyond his means, above 10% in certain cases, South Africa maybe is to strengthen our intra-regional infrastructure. So there's a whole focus in our budget to really improve our corridors, our economic development corridors, whether it's a link to the eastern port, to the western port, or the link to Zambia and Copper Belt. So there's a whole focus around improving efficiencies, which this economy needs, because if you're going to be a bigger economy, you need the numbers. South Africa has got over 45 million people, but if you can include the rest of the subcontinent by investing on infrastructure and making sure that the trade flows and services do happen, I think we'll stand a better chance in terms of being a member of BRIC, given the discussion we're going to have later this evening.
Better tax collection and the fact that we were talking about 1 million people who'd lost their jobs in the last 18 months. Does it mean that more people are paying tax, and so maybe a lot of those people who'd fallen through the cracks have now been absorbed in the system?
No. What we've seen is that it's mainly companies and individuals, because what has happened is that those companies that weathered the storm of the global economic crisis have been able to produce good results, and therefore those continue to declare dividends, which are reflected in the stock exchange, as well as the investment by a lot of traders in the asset management environment through the Johannesburg Securities Exchange. So there's a lot of that has happened. But overall, it's really companies as well as high net worth individuals who continue to sustain the South African tax or revenue base, which in the long term is sustainable. We need to create a much more diversified tax base, and it's been a battle for South Africa because we've got a very small pool of employed people. Right. Therefore, the focus on the new growth path is around labor-intensive employment or GDP growth.
Right.
Whether the policies that the government has got today will lead to that, it remains very, very questionable, given the fact that we still have got lots of deficiencies in terms of logistics as well as energy.
I mean, if employment remains sticky, and I mean, it's quite reflective in the general state of manufacturing. We've seen PMI figures above 57, so that's an improvement. But employment still hovering at the 50 points level, which suggests that, you know, the factories are producing, but the jobs are not being created. You mentioned the new growth path and labor-intensive industries. Manufacturing is the second contributor, or second largest contributor to GDP in this country. What needs to give, do you think?
What has to be done is that within the manufacturing sector, the labor movement has got a very strong stranglehold. Therefore, in economic theory, if you read economic theory, whether it's the general theory of employment by Maynard Keynes, or you read Kalex's thesis, it's very, very clear that in difficult periods, wages has to fall. There has to be flexibility in the labor market. In South Africa, wages keep going up. Therefore, in that process, this economy, particularly the manufacturing sector, is unable to absorb new employees because the labor continues to demand high wage. We know that's going to have strike in the next 3 months, given the fact that it's negotiation season. Therefore, until we're able to have a flexible labor market, we're unlikely to absorb the thousands of South Africans who have not seen a job since 1994 and who will remain outside labor market for many, many years to come until there's labor market flexibility.
And that's compounded by the fact that we've got the looming threat of global inflation, imported inflation from food and fuel costs, which will add to the cost of living, and so demands for higher wages. So if companies can't afford to pay the wages and labor's not prepared to budge, what's the middle ground? Well,
the middle ground in South Africa, we know very, very well, is that we invest on technology. Many companies have taken a view that, you know, if I've got inflexible labor market, maybe technology is the way to go. However, as we know in economic theory, that you do get diminishing marginal returns even in technology. We still need people to be there because if the machine breakdown, you know, they need to have people around. So therefore, the investment on machines has happened, and there's only one solution now, that we need to really get the labor market solved. If we don't resolve that problem, I don't think the new growth path will work. And more importantly, it becomes very, very difficult to attract foreign direct investors into our country because we're seen as completely inflexible and therefore very, very difficult to do business.
I'm glad you mentioned foreign direct investment because many experts are lamenting the fact that despite all the fundamentals that are right in the country, from policy to infrastructure, FDI has dropped somewhere in the region of 70% over the last year. How worried are you about that?
Well, if you look, Lerato, firstly, let's disaggregate. If you look in the motor sector, there's been a lot of investment because a lot of the motor players anyway are foreigners. Right. So there's been huge influx in that sector. If you look into the beverage sector, also huge investment, Heineken, etc. But if you look into the core of the southern economy, which is services as well as mining, there we've seen a huge decline. In mining, we all know it's our mining laws, but in the services, it's all to do with the consumer that is at the moment lives beyond the means. So the scope for growth for the 8 million economy is very, very limited. And hence, our efforts to have a really strong regional economy by making sure that we address the problem in Zimbabwe, in Zambia, we bring efficiency so that we become one economy of over 188 million people that's more attractive, that's resilient even during down cycle, so that then we have FDIs which will be able to make money in South Africa.
I think that's a conversation for another day. Lumkile Mondi, Chief Economist and Vice President of the Industrial Development Corporation.